Module 13 deals with adding another contra asset and contra revenue, and both of them are added in the vein of accounting for sales returns. So sales returns is the big topic of this additional piece. You're going to find that it matches pretty nicely if you think about them generally enough with the allowance for doubtful accounts and bad debt expense. So a right of return, right? We're all familiar with that. We've bought merchandise that we have the unconditional right of return. We account for this on the business side very closely to the way that we do with bad debt expense. Because the rights of return are going to help me generate sales revenue, right? Any amount of revenues that are generated during the period, we have to match by the matching principle all costs associated with generating that sales revenue. And let's be honest, right? A return is a key inducement to me personally buying a piece of merchandise. If I know I can take this back, I'm much more likely to buy it in the first place. So the key of this, though, of course, is we have to account for those expenses in the time of sale. And by the time of sale, what I mean is in the same accounting period. So if we are measuring a quarter and providing a quarterly report, then we have to take those sales data and project what our returns are going to be, what the cost of making those sales is in terms of the returns that could potentially happen even before those returns occur. Same is true for a year. If we're accounting for a year, we have to calculate what effect will selling merchandise with a right of return have on the sales that we've recorded. So there's really two avenues here. Either the company has reliable records or the company has no reliable records recording how returns occur for their merchandise that they're selling. So if they do have those reliable records, then those records are going to be used in order to project the likely value of sales returns to make the estimate that will arise from all of the sales we made in this period. If we don't have those records, then they have to wait to actually recognize revenue from the sale until the right of return window expires. And so in a lot of cases, that'll look like this, where we record an account receivable for the credit sale, and then we have a deferred revenue account. And that deferred revenue, the obligation that we have to discharge is sitting by and waiting until the return window expires. And hopefully they don't return, then we can record the revenue. If they do return the merchandise, then we can debit deferred revenue, credit the account receivable, just flip it. Of course, this would be the same thing with a cash sale. If we sold something for cash and we didn't have data about the return window on that item that we sold, then we would wait to record the revenue until the return window expired. So either way, it's a matter of deferred revenue, an obligation that we have to wait until that return window expires. So let's focus on having that accounting data, that historic data that allows us to estimate sales returns. So if there are sales returns, well, in our initial recording of the sale, we recognize revenue, right? We recognize revenue as a debit to accounts receivable, a credit to sales revenue, or a debit to cash and a credit to sales revenue, but we recorded some revenue. But if a sales return occurs, we are going to do one of the following based on whether we have cash-based returns or credit-based returns. If it was a credit-based sale, and we didn't receive any cash, the customer brings back their item. We reduce accounts receivable because now that customer no longer owes us money, and we record a sales return for that amount to lower the net income. That is offsetting the revenue that was recorded when it was originally sold. And the same is true for our cash-based returns, except we received cash from the customer. Now they're returning the item. So it's still a matter of reducing the net income that are recorded at the point of sale and reducing cash because we'd have to pay our customer back the cash they gave us at the point of sale. So that's just when sales returns are occurring over the period. Now, one caveat I have to attach to this is we do the first one, this piece, only when our allowance for sales returns is zero. And we'll talk a little bit about the allowance for sales returns and how that's what that, it's very similar to the allowance for bad debt, but essentially, this is our estimate account that's made at the end of a period based on how many returns we believe we're going to get. For cash-based sales, we do this only when the refund liability associated with cash sale returns is zero. Prior to these two items being zero, if they are not yet zero, then we debit those accounts. But again, we'll look a little bit at this in a problem on the next page, where instead of debiting sales returns, if there's a balance in either the allowance for sales returns or the refund liability, if there's a balance remaining there, our debit goes to those accounts until they reach zero. So sales returns is a new account, right? It is a contra equity account, but more closely tied to our sales revenue. So it's a contra revenue account, and it reduces sales revenue to report net sales on the income statement. So as a contra revenue account, its rules are opposite of a revenue, where it increases with debits and decreases with credits. So at the end of the period, we're probably going to have some merchandise sold where the return window has not yet expired. And if it's not yet expired, there's the potential for the return. So we have to make an adjustment equal to the total amount that's expected to be returned that hasn't yet occurred. And so how does that usually function within a company? Usually they're going to take a number like total sales revenue that they made on cash base on cash and credit based sales, and then multiply it by a percent. And then at the year end, we determine the potential amount of remaining returns. We look at basically the sales revenue from sales subject to returns, cash or credit based, multiply it by that percent. This is indicated by historical records. And then we subtract off any of the returns made by the period. Right. So if we expect $10,000 of returns to occur in a given year, based on our revenue projections, 9,000 of those have already occurred during the year. So during the year, we made this entry as they were coming back in. We canceled people's outstanding accounts with us because they returned the merchandise. We recorded a debit to sales returns or a debit to allowance for sales returns based on whether that account was already zeroed. Same thing for cash-based sales. So for $9,000 of that, we're making these entries as things are coming in during the period. So this is what I would call in keeping pace with my bad debts. These are my actual sales returns. This is an actual transaction that happened during the period, very similar to my actual write-offs that happen when I identify a specific customer account of customers who will not be able to pay me. I zero their account. Well, this is an actual sales return. They brought the merchandise back, and I debited sales returns, credited their receivable since the allowance for doubtful accounts for sales returns is zero already, right? If it's not zero, it's a debit to the allowance for sales returns, a credit to accounts receivable. So have a little bit of flexibility in that piece. And you might just even write that in there, like it could be one or the other based on where that account is. Given that projection of $10,000 from our return from our sales data, 9,000 have been returned. We still have 1,000 still outstanding. Then that 1,000 becomes my estimated sales returns outstanding. So these are the sales returns that are potentially remaining. And this is my adjusting entry. So now there's two adjustments that have to be made with respect to credit sales. The first is allowance for bad debt expense. The second is more sales returns that could potentially happen in the next period, credited by the allowance for and credit the allowance for sales returns as that rolling estimate of items that have yet to be returned but could potentially be returned. Again, very similar to the bad debt expense allowance for bad debt. This is also that adjusting entry that's made at the end of the period. Remember, most estimates in accounting are adjusting entries. For cash-based returns, instead of dumping in our potential future returns into the allowance for sales returns, for those cash-based ones, we're going to use the refund liability account. And so instead of crediting the allowance for sales returns, we credit a refund liability, which is, as it mentions itself, is a liability account. So what is this allowance for sales returns? Very similar to ADA or allowance for doubtful accounts. It represents a contra asset account. A contra asset account that is tied to accounts receivable. It reduces the overall accounts receivable to produce our net realizable value on the balance sheet. So now to find net realizable value, we want to think about three things: accounts receivable, less your ADA, less your ASR. So it's accounts receivable less its allowance accounts. Now, when we're doing this, there's an additional layer. If we are selling merchandise, right, which usually is the case on a return, what are you going to return if not merchandise? It's hard to return a service. So when we're dealing with this merchandise, we have to make adjustments to inventory and cost of goods sold as well. And so we'll look at this a little bit under the inventory chapter and see how that will play out. I don't want to necessarily introduce the cost of goods sold piece in this material. So just be mindful that an adjustment is necessary, because when people are making returns, they're returning inventory, right? And if they returned inventory, then we have some cost of goods sold to reverse as well. So let's look at an example with a right of return. Thor Inc. offers a 3-month return window on merchandise that it sells on credit. They made $374,320 of sales returns. I'm sorry, sales returns of credit sales. Thor's records are that a 4% likelihood all sales will be returned within a 3-month window. So during the month, they recorded 11,753 of these returns, and we need to provide the journal entries and an adjustment that's required, all assuming that the company began with a credit balance of $5,000 in its allowance for sales returns accounts. So during the year, we made a lot of credit sales. And those credit sales, of course, would be accounted for accounts receivable with sales revenue. We have the historical data so we can record the sales revenue because we have that 4% likelihood intact that we can refer to in order to develop an expectation of sales returns. Remember, if we don't have that, we can't record revenue here. It has to be deferred revenue. So we have $374,320 here of sales returns. So I keep saying sales returns of credit sales we've made, and the customer has rolled away with those products. During the month, we have $11,753 of sales returns. Now, we want to use this because when customers are bringing items back, they are actually going to cancel out their accounts in the case of credit-based sales or receive cash back in the case of cash sales. And we only do the sales returns account here, the debit to sales returns, our contra revenue account, when the allowance for sales returns or the refund liability are zero. But in this case, it has a $5,000 balance in my allowance for sales returns. So the allowance for sales returns is telling me essentially that at the beginning of this period, I still had $5,000 of things that could be returned. Well, I had $11,753 of returns. Remember, this is just my estimate from the prior period. Our customers gave us some fact checking on that estimate. We recorded that many of returns. So the very first thing I'm going to do is debit my allowance for sales returns by 5,000. That will take this account to zero. Essentially, we have now recognized all of the returns that came from sales in the prior period. Now that we've eliminated those, the rest of this amount, the 11,753, goes to sales revenue. And I'm going to talk a little bit about that in a second. In either case, the customer is returning and no longer owes us any money. So we can cancel their accounts receivable due to the fact that they no longer have our product that we sold them. They gave it back to us. Same here. When there's an actual return, that customer no longer owes us money and we cancel their accounts with our company. Now, the big difference, obviously, here is the debit. And let's talk about that debit for a bit. Up here, when I'm debiting out the prior period sales, I'm reducing net income. I'm sorry, oops, not income. I jumped ahead of myself. Up here, when I'm doing that, I'm increasing my assets because I'm getting rid of my ASR. Well, I'm increasing my assets with the debit. I'm reducing them with the credit. So there's no net effect going on here, right? It's very much like a write-off in bad debt expense land, right? I've already accounted for these returns and their effect on net income from the prior period. When I established this $5,000 account in ASR, I debited sales returns and credited the allowance for sales returns. That accounted for the sales returns that were generated by prior period sales, and included that estimate of sales returns not yet made in the appropriate period. These now must be coming from this period's sales because we've already zeroed out all of the remaining returns from the prior period. Now we start charging against net income. This is our contra revenue account because these returns must have come from, according to our estimate, this period's sales. So we've accounted for $6,753 of sales returns that came from this period's sales. The remaining piece is what is the year-end adjustment we have to make? So this is our adjustment for remaining returns. It is an adjusting entry, adjustment. But just to be clear, I'm not using that term lightly. It is definitely technically an adjusting entry. And in order to have the full effect of our expense, our cost of inducing these sales with sales revenue of things that are able to return, we have to debit sales revenue. And we're going to stick that in to our forward-looking allowance that says, hey, there's still some items that are in an account that are credit-based in an account receivable that could potentially be returned. So sales revenue is a contra revenue. It reduces net income. ASR is a contra asset. Crediting it reduces assets. The amount that we have to do it by is based on the percentage likelihood applied to the amount of credit sales we made this period. So this period's credit sales were $374,420. We estimated that 4% of those will likely end up being returned and not recognizable as revenue ultimately because of that return. When we do the math here, we find that it is equal to 14,977 if I round. Oops. I made a slight error. 374, 320. Not 420. So that's $14,972. 3 if we round. Okay. So that's my rounded amount of total sales returns from this period sales. How many sales returns from this period sales have we already accounted for? So you got to be a little careful understanding the difference between these two entries. Remember, this entry is eliminating all of the sales returns from prior period sales. This guy is sales returns from this period sales. What are we projecting here? Are we projecting the total sales returns from prior period? Are we projecting the sales from prior period and this period, or just this period? We're using just this period's revenue to get the total sales returns that are anticipated for the current period. So how many of this amount, 14,973, have we already recognized? Well, looking at these two choices, this is not from the current period. These were returns from the prior period. They were in the beginning of the period estimate of things that could still be returned from the prior period. So that's not applicable. The only sales returns we've actually had from this period are $6,753. So when I take that total amount of sales that I'm anticipating, sales returns I'm anticipating from my sales revenue, and subtract off the amount that's been returned, I get the amount that I need to recognize in order for me to log the adjusting entry that would be required. So we expect from this period sales 14,973 in total. This is the amount that's come back already this period. Now we have 8,220 more that we expect to be returned. So now this sets up the ASR for the next period. And that becomes our adjusted balance for the sales returns accounts going into the next accounting period. Then the process repeats itself. In the next period, I make more credit sales. In the next period, customers bring returns back. I exhaust this to zero. Once it hits zero, any additional returns are logged as a debit to sales returns, a credit to accounts receivable. And at the end of the period, I say, how many total sales returns do I anticipate from this period sales? I apply my percent. I figure out that total amount. That total amount, I take off any that occurred, any returns that occurred from this period sales. And then I project how many could still be outstanding from the current period's sales.